Good morning, 100% here. Today we are going to discuss about the financial management and a finance nature and function. So financial management, first what is a financial management. Financial management is broadly concerned with the acquisition and use of funds by the business firm. It refers to planning, acquiring, utilization and controlling of financial resources or activities. It deals with investment decision, financing decision, dividend decision, liquidity decision and budgetary control. According to R.B. Osborne, the finance function is a process of acquiring and utilizing the funds by the business. Next, overview or objectives of financial management. First one, assessing capital needs, determining capital structure, creation of effective financial policies, resource optimization. Assessing capital needs. Financing managers needs to evaluate factors such as a cost of current and fixed asset, cost of marketing, need for buffer capital, long-term operation and human resource cost, etc. Successful business have clearly defined short-term and long-term financial requirement projections in place. Determination of capital structure. A company capital structure is the framework that determines decision as a debit equity ratio in the short term as well as the long term. Creation of effective financial policies. There is a need to frame efficient financial policies that govern cash control, the lending and borrowing processes, and so on. Resource optimization. Great financial managers are able to navigate through different scenarios by making opportunity use of available financial resources. This would reduce the cash burn and increase the cash burn to generate a maximum ROI. Then what are the scopes of financial management? First one, estimating financial requirements, deciding capital structure, selecting the source of finance, selecting a pattern of investment, proper cash management, implementing financial controls, proper use of surpluses. Goals of financial management. First one, profit maximization, maximizing earning per share, shareholders' wealth maximization. Profit maximization. It is a traditional approach and the primary objectives of financial management. It represents the process or the approach that makes a profit EPS as increased earning per share. Advantages and disadvantages of profit maximization. Economic survival, measurement standard, social welfare, economic welfare. And the disadvantage adds to the concept of profit, ignores time value of money, ignore risk, ignore quality. Next one, wealth maximization. Wealth maximization means maximizing the value of the shareholders in terms of market value of shares and value of the firm. This involves increase the earning per share of the shareholders. Wealth maximization is generating, rewarding, and operationally and managerially the better objective because time value of money, risk or uncertainty of future earning, effect of dividend policy and the market price of the share. Next, what are the steps to achieve the objectives of wealth maximization? First one, the objectives of financial management as such, they should be efficiency to owners, management, employees, and customer. These objectives can be accomplished only by maximizing the value of the firm through the following ways. Increasing in profit, reduction in cost, source of fund, minimize the risk, long-term value, good track record of dividend payment. Under the wealth maximization, you have the maximization of shareholders' wealth. Wealth equals to net present value of financial decision equal to present value of future cash flow or cost. Then it will show the success of the source of wealth. Then difference between the profit maximization and wealth maximization. Profit, it does take into the account time value of money. It takes into the account time value of money. It does not take into consideration the uncertainty of future earning. It takes into the account the risk factor. It does not consider the effect of individual policy on market price of shares. It takes into an account the effect of individual policy on market price of shares. It does not differentiate between the short-term and long-term profit. It considered the different strategy for long-term and short-term profit. Then fundamental principles of finance, the business proposal rewarding of whether it is a new investment or acquisition of another company or a restructuring initiative raises the value of the firm only if the present value of the future stream of net cash benefits expected from the proposal is greater than the initial cash outlay required to implement the proposal. Thank you.